Hi everyone, welcome to our latest quarterly update. I'm joined once again by our global CIO multi-asset, Greg Hurt, who will take a look back, a look forward, and discuss the implications of developments for portfolio positioning. Hi Greg.
Hello.
So what were the principal developments over the last quarter?
Well, thanks everybody for having me here again. Receding inflation and the expectation of rate cuts in 2024, especially the pivot from the US Federal Reserve, drove equity markets higher at the end of last year, and this rally has continued in January as hope grows for a soft landing. Indeed, consensus among many investors is that inflation has been tamed and rates are unlikely to go any higher. Looking at the sector levels, real estate has been one of the biggest beneficiaries of the recent rally, with industrials also posting solid gains. On the flip side, energy weakened, hit by declining oil and gas prices. Looking at fixed income, the rally that began late last year has continued. Yields have declined sharply as inflation data exceeded expectation, with 10 years US Treasuries trading below 3.9% for the first time since July, and also the 10-year German Bund falling to a one-year low of just under 2%. And even gilts, UK gilts, briefly slipped below 3.5%. Meanwhile, the situation in Japan offers a sharp contrast. As we had expected, Japanese government bonds were lagging the gains made in other markets amid speculation that the Bank of Japan would soon end its policy of below zero rates. Turning to currencies, the yen strengthened also due to speculation on a band of Japan policy shift. The euro and pound also rallied against the dollar after US policymakers pivoted to a more dovish stance amid receding concern about inflation. As mentioned, energy prices have trended lower, while gold has surged, hitting a record price in late 23, as declining geopolitical outlook and a weaker dollar boosted the demand for safe havens.
Thanks, Greg. And could you give us an impression of what you expect over the coming quarter?
Well, with a few exceptions, most notably in Germany, recent economic indicators have surprised on the constructive side, signaling that the current late-cycle environment may last a bit longer than many had expected. And as we emerge from a period of central banks dealing with post-COVID shocks, we expect markets to show less volatility in the coming months, and of course then a more predictable market environment that may lay ahead. Overall, the economic picture is indeed improving and could have more legs, though we believe that the risk of a US recession in 2024 are certainly being a bit underestimated by the market participants, as most of them accept really a soft landing. That said, the probability of this happening in the first quarter of this year has dropped markedly. We thus believe actually that equity markets will put in a positive but likely unremarkable performance over the coming year. However, quite tactically in the short term, there is some risk of market consolidation, as expectation regarding the speed of rate cuts may have been a bit over-optimistic, and of course investors have also peeled into equity. Regarding fixed income, there remains further potential for yield compression in the medium term as inflation continues to weaken. On commodities, the picture is actually pretty neutral at the moment. We are still waiting to see gold to cross its resistance level, while oil looks much more constructive due to the well-balanced supply and demand dynamic, and is actually used as a hedge against the deteriorating geopolitical situation. The biggest worry for us is natural gas. It is likely to come under pressure due to relatively high inventory levels.
Thanks, Greg. And given these developments and your outlook, maybe you could say a few words about portfolio position.
Given the strong tailwinds and momentum with which we enter 2024, we continue to have an overweight position in equities, even though not as strong as we used to have at the beginning of the year. And this in particular in Japan. The latter is our current preferred region as it enjoys an attractive mix of momentum, loose monetary policy, and resilient domestic economic data. In fixed income, we continued to become more constructive in December, and we are now overweight across all the major fixed income segments. Indeed, we are the most constructive on sovereigns, particularly Eurozone exposure. However, we are a little bit more cautious around high-yield spreads, as we have seen them reaching historically low levels. Finally, on currencies, we maintain quite a positive stance on the US dollar versus the euro, while we favor a long Japanese yen on valuation and potential central bank intervention.
Thank you, Greg. Interesting and informative as always. And thank you for joining us.
Thank you, everybody, and see you next time.